I want to ask you something about the last bonus you received. When it landed, when you saw the figure in your account, what did you do with it? Did you spend some of it? Save some of it? Pay down debt? Move it into an ISA? Or did you do what most people do? Accept it as it arrived, pay the tax that came with it, and move on. If you accepted your last bonus without thinking about the tax year it landed in, the pension contributions you'd already made, and whether your adjusted net income was protected, you almost certainly overpaid tax on it. Not by a small amount, potentially by thousands of pounds. My name is Mark. Welcome back to Wealth Architecture. Today we look at the relationship between salary, bonus and pension, why it matters, what most people get wrong, and what a structured approach looks like instead. Most people think of a bonus as a simple lump sum with a fixed tax rate. They receive £10,000, they assume 40% tax, and they expect to keep around £6,000. But that's not how it works in practice. A bonus doesn't sit on its own. It lands on top of your salary, and the tax it attracts depends entirely on where your total income sits at that moment. The same £10,000 bonus can lead to very different outcomes. In one case, you might keep £6,000 after 40% tax. In another, you might only keep £4,000 if part of it is effectively taxed at 60%. In another situation, you might keep around £5,500 if it falls into the additional rate band. Same bonus, completely different results. It all depends on where your income sits when the bonus arrives. Imagine your salary already takes you to £95,000. Then a £10,000 bonus lands on top. That pushes your adjusted net income to £105,000. The portion above £100,000 starts to lose your personal allowance, creating that 60% effective tax rate. That's not rare. It happens every year to people in senior roles across the UK. Most don't even realise it's happening. A bonus isn't just extra money. It's a tax event. And like any tax event, you can plan for it, or you can ignore it. Most people ignore it. Not because they're careless, but because nobody ever explained that they should be thinking about it in advance. Before we go deeper into bonuses, there's something important underneath all of this. Your salary is the one part of your income you can predict with confidence. You know what it will be across the year. You know how much of the tax bands it already uses up. That makes it your starting point. But most high earners treat salary as something fixed and untouchable from a tax perspective. They receive it, pay the tax, and move on. The reality is slightly different. Your salary sets your position. Your pension contributions determine where you actually end up. For example, if your salary is £95,000 and you make no pension contributions, then a £10,000 bonus will push part of your income into that 60% band. But if you've already made £10,000 of pension contributions, that same bonus can sit below £100,000 instead. That means it's taxed at 40%, not 60%. The timing of your pension contributions changes the tax outcome of your bonus. Once you see it like that, it becomes much clearer. But it does mean thinking about your income as one combined picture instead of separate pieces. Let's make this real. Two people work for the same employer. They both earn £98,000. Both are expecting a £15,000 bonus in March. Tom does nothing. He waits for the bonus to arrive. When it does, his total income for the year becomes £113,000. That means £13,000 falls into the 60% band, and he pays that higher effective rate on it. Priya takes a different approach. In January, before the bonus arrives, she looks at her numbers. She works out that if she contributes £13,000 into her pension, she can bring her adjusted net income back down to £100,000 once the bonus lands. So she makes that contribution, using a mix of salary sacrifice and a personal pension payment. Then March arrives. Both receive the same £15,000 bonus. Tom's adjusted net income ends up at £113,000. Priya's ends up at £100,000. Tom has £13,000 exposed to the 60% band. Priya has none. Tom pays roughly £2,600 more in tax than he needed to. Priya, on the other hand, has effectively turned that situation into an advantage. Her £13,000 pension contribution only costs her around £5,200 after tax relief. At the same time, she avoids the extra tax and builds her pension. Tom didn't do anything wrong. He just didn't make a decision. And when it comes to tax, doing nothing is often the most expensive option.
It's worth looking at pensions slightly differently in this context.
Most people think of pension contributions as something long-term, something for retirement, something you do because you're supposed to. But when you're dealing with bonuses, a pension becomes something much more immediate. It acts as a buffer. It determines what tax rate your bonus will actually face when it arrives. Used properly, it can be the difference between that bonus being taxed at 40% or 60%. That difference is real, and it happens straight away. If you have a rough idea of your bonus before the end of the tax year, which most people do by January or February, you have time to act. You can estimate your total income, calculate where you'll land, and make the necessary pension contribution before the bonus arrives. There's nothing complicated about it. It's basic arithmetic. The only reason most people don't do it is because nobody has ever framed it in this way.
There's a pattern running through all of this.
People who consistently pay less tax aren't using complex strategies or specialist knowledge. They're simply looking at their income as a whole. Salary, bonus, pension, benefits, they're all part of the same picture. And that picture is summarized in one number: your adjusted net income. The mistake most people make isn't misunderstanding the rules, it's treating income as something that just happens to them, instead of something they can shape. Tom and Priya had the same salary. They received the same bonus. One paid significantly more tax. The only difference was a decision made a couple of months earlier.
If you receive any form of bonus or variable pay,
There's a simple process you can follow each year before April. First, estimate your total income for the year. Include your salary, expected bonus, any benefits, and other income. It doesn't need to be perfect. A rough number is enough. Next, work out your adjusted net income by taking into account any pension contributions you've already made. Then look at where that number sits. If it's above 100,000, consider what contribution would bring it back down. If needed, make that contribution before the bonus arrives. That might be through salary sacrifice if your employer offers it, or through a personal pension if not. Timing matters. Most people who do this properly follow a simple pattern each year. They estimate their income in January or February, they make any necessary pension contributions in February or March, and once the tax year closes in April, the opportunity is gone. The window is short, but the impact lasts. In the next video, we step back and look at a bigger picture. Most high earners aren't overpaying tax because of one big mistake. It's usually a series of smaller ones that build up over time without being noticed. We'll break those down and help you spot whether you're making them. If you recognized yourself in Tom today, if you've ever taken a bonus without thinking about when it lands or how it's taxed, subscribe, because the next video will hit even closer to home. I'll see you there.